From our perspective, maybe I give you some background about what we have been seeing in the past few years. After the China real estate crisis, there's been a lot more demand for indices that are ex-China. People are looking at how to either manage China separately, underweight China, or have more credit risk assessment for the Chinese bond market that they are managing. So, but this year, I mean, this is the past year or so, since last year, we have seen a lot more stimulus, more policy support coming from the Chinese regulator. They have been really trying, I mean, almost every other month you see a news report about what they're trying to do to help with to stimulate the market, stimulate the economy. And through our indices that compares either Asia ex-Japan, ex-China, or like Asia ex-Japan, simply whether you ex-China or not, this year, if you include China, you will have boosted your performance. So it has been more rewarding for the investors that have overweight or included China in their portfolio. This is one of the observations that we have seen. And then the other thing is because of the stimulus and the policy support that are targeted at the real estate market, we have seen either they are trying to, one of the policy was to provide either funding for the local governments to purchase the unpurchased residential homes, lowering mortgage rates, lowering down payment ratios, that sort of thing. It has, I think it has cemented the perspective of how investors look at the Chinese regulator. They have shown their commitment to the China real estate sector, and through that, we've seen the bond performance based on our sub-index that captures the USD-denominated China real estate market, and it has been trending upwards for the past 12 months. And I think the number, the return since last October, it should be more than 43% right now. But this is given the fact that it went down quite a fair bit, so they'll take that with a pinch of salt. And then one of the other thing is, even though I said like more positive things about China so far, I just want to bring it back to a more objective stance, which is we still have to bear in mind, for tactical investors especially, that China onshore rates is still low relative to US rates, and that could be a deterrence for yield seekers. The tactical investors that are looking for higher yielding bonds might not be as attracted to China onshore at the moment. But we do have a lot of inquiries from our clients discussing about China. For those strategic long-term investors, they do see that you can't ignore the second biggest bond market in the world. It's too big to ignore. And one of the trends that pop up is we're moving away from talking about just government policy banks. People are interested in domestic credit space. Like this is because the rates products are too saturated right now in the market, right? So yeah, that's my 2 cents.